What is up, everyone? Welcome to Investing Club. The stock market crash is starting. Today has been a horrible day for the stock market. Dow Jones down almost 4%. And in this video, I'm going to talk about why it's been happening and some signs that show that this is about to get bad. The stock market is in a huge bubble right now, and it is in the process of starting to burst. So I'm going to go over why in this video. Stock market crash starting now, the bears are coming back out, and let's see why this is happening. So I've talked about this in previous videos. This bubble is corporate debt. Corporate debt to GDP is the highest it's ever been. And you can see throughout history, during all of these peaks, is when a recession happens and a stock market crash happens. We get to a peak in the credit cycle, which happens typically every 10 to 15 years. And then we see a sell-off in the stock market. And right now, we are at the highest level of debt to GDP we've ever seen. And I've touched on this in previous videos. Why is all this debt being taken out? Why are all these companies taking out such a high amount of debt? And the answer is for share buybacks. Again, this chart still blows my mind. Since 2009, 90% of net demand in the stock market has been from share buybacks. Companies buying back their own shares essentially created 90% of the stock market rally over the past 10 years, more than households, more than the foreign sector, more than pension funds. Households were actually negative during this time. So during this huge bull market rally, a lot of households missed out on this rally caused by share buybacks. And why are companies buying back all these shares? Because it pumps up their stock price. It increases their earnings per share, makes them look like they're making more money, and so that will make their stock be valued more highly. We can see that with this chart. Reported earnings boosted from buybacks. The difference in earnings per share as a result of buybacks just goes straight up. As more buybacks are happening, the earnings per share of these companies go up, and that tricks investors into thinking, well, this company's making more money now, they're more valuable, and we're going to pour all this money into the stock. And I said in my video a couple months ago on why the stock market will crash, talking about stock buybacks, I said these buybacks are about to stop. And not only are they about to stop, these companies are about to face the consequences of taking on all this debt over the past 10 years, and we are starting to see this right now. This is one of the first signs of this bubble starting to burst. Wells Fargo files for a $13 billion mixed shelf offering. So what this company is doing is Wells Fargo is issuing new shares to raise money. And we can see the proceeds will be used to repay maturing debt, reduce outstanding debt, repurchase securities, and invest in the company's subsidiaries. So this company is selling shares to pay off debt. And what's the most ironic part about this? This company took on debt to buy back shares in the first place. So this company took out debt to buy back shares, and now they're selling shares to pay off the debt. So they really cancel each other out. This huge illusion that actually didn't do anything. And now we're going to see them cancel each other out. And what is the biggest problem with this? Well, Wells Fargo's stock price has tanked. Take a look at the long-term chart of Wells Fargo. When they were using debt to buy back shares, look at where the stock price was. The stock price was in the 50s and in the 60s. This was a $50 to $60 stock during this whole period when they were buying back shares. And now they have to reissue shares when their stock price tanks at $27. And this is basically a reverse share buyback. This company bought shares when they were high and are selling them when they are low, which is the opposite of what you want to do. And it's not really like this company has a choice. They're forced to, because they have all this debt and they really have no other way to pay it off besides issuing shares. And so this is a chart of Wells Fargo shares outstanding, and from 2010 it's just been going down. This company's been buying back shares. They had over 5 billion shares, and right now it's down to almost under 4. So this company has been buying back shares like crazy, and even though now it's not going to mean anything. Another thing you can see is this is the chart of the long-term debt. And at the same time that the share count is going down, the long-term debt is going straight up. We can see they had 129 billion in 2012, and now they have 237 billion. So they've doubled the amount of long-term debt they had, and the only reason that happened was to buy back shares, which they're now going to have to issue again. So it really resulted in absolutely nothing except them having more debt. And this problem is not isolated to only Wells Fargo. We've already seen this with Carnival Cruise Lines issuing shares. We've already seen this with the airline companies. And I think this is just the start. We're going to start to see a lot of struggling companies that have been abusing share buybacks have to start issuing shares to pay down the debt. And the problem with this is a lot of these companies' share price are going to go so low that they're not going to be able to raise enough money to pay back the debt. And then what's going to happen after that? The shareholders are going to get wiped out of a lot of these companies. And so the biggest problem with with issuing new shares is it destroys the shareholder value. When Carnival Cruise Lines diluted their shares by 40%, what does that mean? Their earnings per share are going to be 40% lower. So if you're someone who's hoping that stock's going to go back to $50, $60, $70, newsflash, that's not going to happen anytime soon, since their earnings per share are going to be so much lower now that they issued all of these new shares. We can take a look at another great company, McDonald's. McDonald's is an outstanding company that's going to be here for the next 100 years. McDonald's right now actually has negative book value just because of all the debt they've been taking out. They had positive book value pretty much their whole history up until 2015. And then they realized, well, wait a minute, interest rates are so low right now, we can just take out a bunch of debt and buy back our shares, and that'll make the stock price go up. And since 2015, what have they been doing? They've just been increasing their debt, which is reducing their book value. It's been decreasing pretty much every year since back to 2013. And does this work in the short term? Yeah, of course it works, because investors don't even realize what these companies are doing. We can take a look at the short-term McDonald's chart. And from 2011 to 2015, this company really didn't do anything. For 4 years, it went sideways. At the beginning of the new bull market, where the whole economy, the whole stock market was going up, for 4 years, McDonald's didn't do anything. And in 2015, when they went to negative book value and said, we're going to take out all this debt and buy back shares, look what happened with the company then, a massive bull run over 100%. So it works. It fools investors. And this is the worst part. The worst part is you probably own these companies that are doing this, and you probably don't even know it. If you own stocks in the Dow Jones, if you own stocks in the S&P 500, and the worst part is that investors don't even know about it. It's all just a bunch of smoke and mirrors, and like I said, I think it's about to end. We've already seen it. We've already seen multiple companies start to issue shares, and that's just going to accelerate the longer that this economic slump goes on. Now, the Federal Reserve just had a meeting, and they said they're not even thinking about raising interest rates. And the Federal Reserve realizes the problem that these companies are in right now. I'm probably going to make a whole video on their meeting and what that means for the economy and the stock market. But the Federal Reserve realizes we can't raise interest rates right now. There's so many companies that do this. If we raise interest rates, they're all going to get wiped out. They can hardly repay the debt now when it's at rock bottom interest rates. If we raise it even a little, we're going to send so many companies out of business. And so that is a huge problem right now. As I've said, the interest rates can't stay this low forever. With all the money printing the Federal Reserve is doing, we're going to see inflation, and to control that inflation, interest rates are going to have to go up. And at some point, that's going to happen. And this recent sell-off we've seen in the last couple of days might be an indication that the market's starting to wake up and realize we're in a huge problem here. And that's why the stocks I own, I actually check to see if companies are doing this. And so I don't own any companies in the S&P 500 or the Dow Jones because they've all been doing this. They've all been abusing share buybacks, and now it's about to end, and things have the potential to get very ugly. So that's really it for this video. We're going to see companies start to issue shares when their shares are at rock bottom prices, the lowest they've been in years, and that's really going to hurt the long-term outlook of these companies. So let me know what you think about this. If you learned something new from this video, hit the like button, subscribe to the channel. I post videos like this almost every day, and we'll see if this is the start of another stock market crash, or if this is just a short-term correction and we keep going up. I don't know what ultimately is going to happen, but there is definitely cause for concern right now. Let me know in the comments, do you agree with my opinion that the stock market's in a lot of trouble right now, or do you think the economy is going to recover just fine and these companies are going to keep going up? Let me know, and I'll see you on the next video.